On a cold morning in early 2009, millions of Americans opened their retirement accounts and saw something they never expected. Years of hard work had suddenly lost a huge part of their value. A teacher checking her 401k after decades of contributions. A factory worker watching his retirement dream move further away. A small business owner wondering whether the savings he spent years building would survive. For many Americans, it felt like the financial future they had worked their entire lives for was disappearing overnight. And the fear was everywhere. Banks were collapsing. Companies were cutting jobs. Home values were falling. Confidence in the American economy was breaking apart. But during those frightening months, something unexpected happened. While most people were focused on escaping the damage, a small group of ordinary Americans started asking a different question. What if this is not only a crisis? What if this is an opportunity? They were looking at the exact same headlines, the same collapsing market, the same uncertainty, the same fear. But they saw something most people could not see. When fear reaches its highest point, valuable assets can sometimes become available at prices that may never appear again. One of those people was not a Wall Street billionaire. She was not a hedge fund manager. She was not a financial expert with secret information. She was simply someone who understood one powerful idea. Sometimes the moments that feel the most dangerous are the moments that create the greatest financial opportunities. In March 2009, the S&P 500 reached one of the lowest points of the financial crisis. The market had already lost more than half of its value from its previous peak. And for millions of Americans, investing at that moment felt impossible. Why put money into the market when everything looked broken? Why take risks when the future seemed uncertain? Why buy assets when everyone was warning that things could get worse? And those fears were understandable. The economy was weak, unemployment was rising, major financial institutions had failed. Nobody knew if the market had reached the bottom, or if another collapse was coming. So millions of people made the decision that felt safest. They waited. They told themselves, I'll invest when things become clearer. I'll buy when the economy improves. I'll act when the danger is over. But history would reveal the problem with that strategy. Because by the time the economy looked safe again, the biggest opportunity had already started disappearing. The Americans who invested during that period did not have a crystal ball. They did not know exactly what would happen next. They did not know the market would recover as strongly as it did. They simply understood one important truth. America had survived difficult moments before. Businesses had survived. Workers had rebuilt. Innovation had continued. And companies creating real value today could still grow decades into the future. They understood a lesson that appears again and again throughout American wealth history. Long-term wealth is often created by people who can act when emotions are telling them to do the opposite. And the results were extraordinary. The years following the 2009 financial crisis became one of the longest periods of economic expansion in modern U.S. history. The stock market recovered. Companies grew. Technology transformed entire industries. And millions of Americans who continued investing through their retirement accounts slowly accumulated ownership in some of the most successful companies in the world. They were not billionaires. They were not professional traders. They were ordinary Americans. Teachers, nurses, engineers, government employees, small business owners, people who kept contributing to their 401ks and IRAs, while much of the country was focused on fear. And this is where the story becomes much bigger than the 2009 recovery. Because the people who built wealth after the financial crisis were following a pattern that has appeared throughout American history. Major wealth creation rarely happens when everything feels comfortable. It happens during periods of major change. After World War II, millions of American families entered the middle class through rising wages, home ownership, and economic expansion. A generation of Americans purchased homes, built businesses, accumulated assets, and created the foundation of household wealth that shaped the country for decades. Then another transformation began. The rise of retirement accounts changed how everyday Americans participated in the stock market. Before that, ownership of major companies was concentrated among fewer investors. But workplace retirement plans allowed millions of workers to become shareholders in the businesses driving the economy. The stock market was no longer only a place for wealthy investors. It became connected to the financial future of ordinary American families. Then came the technology boom. Entire industries were created. New companies emerged. And investors who participated in that growth experienced another major wave of wealth creation. Different era, different technology, different challenges, but the same pattern. When America enters a period of economic transformation, people who own productive assets often have the opportunity to benefit. But now, something different is happening. A new economic shift is beginning. And this time, it is not being created by a stock market crash. This time, the force changing America is something much quieter. It is not a sudden collapse. It is not a financial panic. It is not a moment when everyone is watching the same red numbers on their screens. Instead, it is a massive movement of wealth that has been building for decades. A transfer so large that it could reshape investing, housing, businesses, and financial opportunities across the United States. This event is known as the Great Wealth Transfer, and the scale is difficult to comprehend. More than $100 trillion in American wealth is expected to move from older generations to younger generations over the coming decades. Think about what that means. Homes purchased decades ago, retirement accounts built through years of work, investment portfolios accumulated over a lifetime, family-owned businesses created from nothing, assets that represent decades of American economic growth. All of it will gradually move from one generation to the next. But here is where most people misunderstand what is happening. They think the Great Wealth Transfer is simply an inheritance story. They imagine a person receiving a large check from their parents or grandparents. And yes, some Americans will inherit significant amounts of wealth. But that is only one small part of the bigger picture. Because when trillions of dollars move through an economy, the impact does not stop with the people receiving the money. Money creates movement. It changes decisions. It changes markets. It changes where businesses grow and where opportunities appear. Imagine millions of Americans suddenly gaining access to new capital. Some will buy homes. Some will invest. Some will start businesses. Some will pay down debt. Some will put money into retirement accounts. Every decision creates another economic effect. One person's financial decision becomes another person's opportunity. A home purchase supports builders, contractors, real estate agents, lenders, and local businesses. A new business investment creates jobs. An investment portfolio creates demand for companies and markets. A dollar rarely stays in one place. It moves through the economy, creating new waves of activity. And this is why the biggest question is not simply, who will receive an inheritance? The bigger question is, who will understand how this movement of wealth changes the financial landscape? Because history shows that major wealth-building periods reward people who recognize change early. The problem is that opportunities rarely look obvious when they first appear. In 2009, buying stocks looked reckless. During previous periods of transformation, buying homes, investing in businesses, or owning assets often felt uncertain. The people who benefited had to make a difficult choice, follow the emotion of the moment, or follow the long-term reality. And that is where human psychology becomes the most important part of the story. Because financial opportunities are not only created by markets, they are created by behavior. Two people can experience the same economy and end up with completely different financial outcomes. One person sees uncertainty and freezes. Another sees uncertainty and prepares. One person waits for perfect conditions. Another understands that perfect conditions rarely exist. This pattern has repeated throughout American history. During the housing expansion after World War II, many families built wealth because they purchased homes when home ownership was still becoming widely available. During the growth of retirement investing, people who consistently contributed to their accounts benefited from decades of market growth. After the 2009 crisis, investors who stayed committed benefited, while many others stayed on the sidelines. The opportunity was not hidden. The information was available. The challenge was having the patience and discipline to act. And that same challenge is appearing again. Because the Great Wealth Transfer is not a single event that happens on one specific day. It is a process unfolding over decades. Some transfers are already happening. Some families are already making decisions about estates, investments, and property. Businesses are already preparing for ownership changes. Financial institutions are already adapting to serve a new generation of investors. But there is another important detail most people overlook. The wealth transfer itself does not automatically make everyone wealthy. Simply being alive during a major economic shift does not guarantee financial success. History does not reward people just because an opportunity exists. It rewards people who are positioned to participate. And that difference matters. Because millions of Americans may watch this wealth transfer happen from the outside. They may hear about billions moving. They may see headlines about new millionaires being created. But they may not understand how they can participate. The people who benefit most from economic transformations usually have something in common. They own assets. They understand money movement. They think long-term. They prepare before the opportunity becomes obvious. And this is exactly what happened after 2009. The people who built wealth were not waiting for someone to tell them the perfect moment had arrived. They were already positioned. They had invested. They had stayed consistent. They had allowed time and compounding to work. But the next chapter of America's wealth story is different. Because this time, the opportunity is not only about what happens in the stock market. It is about where trillions of dollars will flow, which industries will grow, which assets may become more valuable, and which Americans will recognize the changes happening around them. Because when the largest movement of wealth in American history begins accelerating, the biggest winners may not simply be the people who receive money. They may be the people who understand what that money does next. Because when money moves on this scale, it creates something larger than individual inheritances. It creates an economic environment. And throughout American history, those environments have created new opportunities for people who were prepared. But preparation does not mean trying to predict every market move. It does not mean finding one perfect investment. It does not mean guessing which company will become the next giant. The biggest wealth building periods in America have usually rewarded something much simpler: ownership, consistency, and time. This is the lesson hidden inside the story of the 2009 recovery. The people who benefited most were not necessarily the people who predicted the exact bottom of the market. They were the people who owned assets when the recovery happened. They owned pieces of American businesses. They continued contributing to retirement accounts. They allowed decades of economic growth to work in their favor. And that same principle may become increasingly important during the Great Wealth Transfer. Because when trillions of dollars move through the economy, people who own productive assets have the potential to participate in that growth. That does not mean every investment will rise. It does not mean every market will succeed. And it does not mean every person will become wealthy automatically. Economic changes always create winners and losers. The difference is understanding how to position yourself. For many Americans, that starts with something simple: building ownership. A person contributing consistently to a 401k. A worker investing through an IRA. A family building emergency savings so they can take advantage of opportunities. A business owner developing skills that become more valuable as the economy changes. Small actions may seem insignificant today, but history has shown that small financial decisions repeated over long periods can create extraordinary outcomes. Consider the difference between two Americans. One spends every extra dollar because they believe wealth comes from appearing successful. The other slowly builds assets because they understand wealth comes from ownership. At first, the difference may not be visible. They may have similar jobs, similar incomes, similar lifestyles. But after 20 or 30 years, their financial realities can look completely different. One owns assets that have had time to grow. The other owns memories of money that was spent. This is why behavioral finance matters so much. Money decisions are rarely only about mathematics. They are about identity. They are about patience. They are about how people respond when the future feels uncertain. During the 2009 crisis, fear convinced millions of Americans to avoid investing at the exact moment when prices were historically low. Today, a different emotion creates another challenge: distraction. Many people are focused on short-term headlines, daily market movements, political arguments, economic predictions. But major wealth-building events are often measured in decades, not days. The Great Wealth Transfer will not happen overnight. It will unfold year after year. And the Americans who benefit most may be the ones who stop focusing only on what is happening today and start thinking about where the country is moving over the next 20 years. So what does positioning for this period actually look like? First, it means understanding that participation matters. Many people wait because they believe they need a large amount of money before they can begin investing. But historically, wealth creation has often started with small amounts repeated consistently. A person investing a few $100s every month may not feel wealthy today. But over decades, those contributions can become a significant financial foundation. The power comes from time, because compounding does something that is difficult for humans to imagine. It allows money to create more money. Then that additional growth creates even more growth. The process starts slowly, then it accelerates. Second, it means developing valuable skills, because wealth movement creates opportunities beyond investing. When trillions of dollars change hands, entire industries are affected. Financial planning, estate services, real estate, business consulting, tax strategy, entrepreneurship. People who understand these areas may find new opportunities because every major economic shift creates demand for people who can solve new problems. Third, it means avoiding one of the biggest mistakes Americans make during times of change: waiting for certainty. The truth is, certainty usually arrives after opportunity has already passed. Looking back at 2009, many people say, "I wish I had invested then." But at the time, investing felt uncomfortable. The same pattern appears repeatedly throughout history. People recognize opportunities clearly after the results are visible. The challenge is seeing possibilities before everyone agrees. And that requires a different mindset. Instead of asking, when will everything become safe? A better question is, how can I prepare while others are still uncertain? Because financial freedom is rarely created by one perfect decision. It is usually created by a series of intelligent decisions made consistently over time. The teacher who invested during the financial crisis did not know she was standing at the beginning of a historic recovery. She simply understood that fear had created an opportunity. Millions of Americans after 2009 followed a similar path. They invested, they waited, they allowed time to work. And years later, many discovered that ordinary decisions had created extraordinary results. Now, America is entering another defining economic period. The Great Wealth Transfer represents one of the largest movements of capital in history. But the most important part of this story is not the number. It is not the trillions of dollars. It is not the headlines. The most important part is what people choose to do with the knowledge that this shift is happening. Because every major wealth-building era creates the same question. Will you understand the change while it is happening? Or will you only recognize it after it is over? History has shown that opportunities rarely announce themselves. They often arrive disguised as uncertainty. In 2009, fear created the conditions for one of the greatest wealth-building opportunities of modern America. Today, another transformation is beginning. The people who benefit will not necessarily be the ones with the most money. They will be the ones who understand the moment, make thoughtful decisions, and give themselves enough time for those decisions to grow. Because wealth is rarely created in a single moment. It is created when preparation meets opportunity. And throughout American history, that combination has changed ordinary lives forever.